Today's myth is that non-bank finance is expensive. This is something that a lot of accountants are going to tell their clients it's expensive. I like to say, well, to the accountant that says that, well, maybe the client should switch to a bookkeeper. That's cheaper. And the accountant, of course, says, no, there's a value add in what I do. And I'm going to demonstrate to you that there's a value add in non-bank finance as well. We're going to use here an example of a manufacturing business that turns over $1 million a year, and they have a gross profit margin of 30%. So here's their gross profit down here, 30%, and that's $300,000. 30% of $1 million, okay? Now, imagine that with the help of some non-bank finance, Hermes Capital perhaps, they can increase their sales to $1.5 million. Now that's not an unrealistic, if BHP said they were going to increase their sales by 50%, you might be a little bit sceptical. But for a small business to grow like that, that's nothing. Sometimes they double. So let's say they're going to increase by 50%. And so now their GP's gone from 300,000 to 450,000. Okay, that's 30% of 1.5 million is 450,000. Now, of course, there's a cost to the non-bank finance, and I'm going to say that there's a hypothetical cost that eats into that margin of around, let's call it in this case, 2%. And I'm happy to talk you through how that maths works if you want to get in touch directly. So how does this all work out? Well, the gross profit now is $450,000. Okay, now, previously it was $300,000. So we're $150,000 ahead in terms of GP. But of course, there was a 2% cost as a cost of finance. And 2% of 1.5 million is 30,000. So yes, there has been a cost, but the business is still $120,000 ahead. So they've actually increased their gross profit margin by 40%. So the cost of the non-bank finance in this case is 2% of sales, but the cost of not taking up the finance is, in this case, $120,000 on growth of $1 million to $1.5 million. So now, of course, if the client was able to borrow from a bank, then yes, this cost here would be less. But in a scenario where your client is unable to get those funds from a bank, there is a cost here that's more than what a bank's going to charge. But as you can see, it's usually the accountants that are against the non-bank finance. As you can see from this equation, it's not the cost of doing the finance, it's the cost of not doing the finance that matters. All right?